All right, so next we'll deal with our term bond. Now I want you to just pay some attention to the facts that have been presented here. One, so you have the face amount of the bond, the interest rate, and the number of years. There's a sinking fund that's to be set up at the end of the year, and each year you're to place money into that sinking fund. You still have to make interest payment every 6 months. And it tells you your sinking fund investments can earn up to 7% per year. So the first question is, how much do you have to set aside for the sinking fund? So at the end of the period, you will have $100,000. Is it 100,000 divided by 5? No, right? And this is where that future value of an annuity calculation comes in. Look at what they did. They went into the table and found out the factor, which is what? 5.750739. And that gives you the 17,389. So instead of putting 20,000, they only need to put in $17,000 because each year they'll earn interest on that money of 7%. And magically, at the end, they have what? $100,000. So their first year cost, debt service cost is what? 17,389. What's the second year? Same number. So what do you have? You have equal amounts of debt service for the entire 5 years, and this is what? Interest being earned in the sinking fund. Very important that you get this concept down, because without that, you can't go further. Okay? You need to know what that is. Okay? All right, so let's take a look at the journal entries, how they operate for the term bond. Not very different. Let's take a look at some of them. This is your budgetary entry. Other financing source, transfer, estimated other financing source, transfer from general fund, right? Debit, credit appropriation. And you know what? We're going to play it safe and try to get more money from the general fund than we need, because what if our calculations are wrong and we don't earn 7%? So we get more and we put it into the budgetary fund balance. Okay? Yep. So that's our first entry. That's our budgetary entry. Now there's a slight deviation from what we have looked at in the past, which is let's expect the money from general fund. Let's set up a receivable from the general fund. I want you to see how to set up a receivable from the general fund. So what you see is due from
other fund?
General fund, right?
Yeah.
And then what do? You credit the
other financial sources.
Yeah. So this is the time that you recognize this quote unquote revenue. Okay. Third, you now get the cash from the general fund. You debit what? Cash and credit from general fund. Anything crazy about this? Oh, looks pretty straightforward, right? Now it's time to pay off. So what's our entry to make the payment?
Expenditure.
Okay, it's expenditure, right?
Interest.
Now what I'm going to do is, let's just do both interest and principal together, okay? But what we'll do here is make one compound entry. Let's just assume we can combine both of the amounts together, because the amount is, remember, you'll pay what? Interest every 6 months, right? Yeah. And you'll pay what? The principal payment at the end of the year, right? So let's just call it expenditure, and I'll just say P&R, okay? Just so that we. So now we have made the payment. Okay, so this is the payment. And really, that's it. Any difference between this and the serial? Nothing really. So, a slight difference when we go to the governmental activity. What are we doing? We are making a payment into the sinking fund. When you make a payment into the sinking fund, where does that money eventually go to? An investment, right? So in the governmental activity, where this number, this 7, let me just shows up as investment and cash. So that payment of the sinking fund shows up as an investment, but in the governmental activity, because that's the only place where we can show investment. These guys are basically what shows up as an expenditure. So that's the difference. How about the closing entry? Any different from the last closing entry? Actually, they are exactly identical as a serial bond entry. You just do exactly the flip of what we had before. It's exactly the same. So what do you notice? You notice that the entries are almost the same. What's the difference? The difference is how do you calculate this, and to what? The principal is, instead of being shown as a reduction in notes payable, what are we doing? We're putting the principal into a sinking fund, which is represented by an investment. That's the difference between this and that. Any questions?
So the investment recognized in the government activity is because it is long term?
Yes, because it's more than a year. Yep. Yep, good question. Yep.
So
remember, we cannot show that in the, if it's less than a year, you can show it, but you're technically not supposed to show that.
and we assume that we can get earnings from investment at the end of the bond term?
No, that we will get this amount of interest. And the question is, what if you don't get this amount of interest? What if you get more than 1,217? Then it goes into what? Fund balance. Right?
Yeah.
Because that's additional amount, right?
Yeah.
Yes.
We also do need to make a generation for the future.
Yes, yes. Thank you for mentioning that. Also, interest accrual at end of the year. Yep, that you have to do that. Yep. Yep.
Why the slide 630, why you're debiting cash in debt service fund, but you're crediting cash in the
Where, which one is that? 30?
630 and 631.
The between and the payment of interest.
Just before 31. Bottom slide 6-30.
Yeah. Are you looking at which one? The one that says 20,389?
Yes.
Okay. So your question is that. Okay. So just before 12 cash and other. So it's recognizing. Remember, that's still in the debt service fund, that entry. It's in the debt service fund, not in the governmental activity.
But the one in slide 12, 631 is that the other?
I'm sorry, which one are you talking about?
The next slide is the next one.
Well, you know what? It says investment. Let me, yeah, good question. here, yes, the confusion is that the book is assuming that this is a short-term investment being made, and they're putting it in the debt service fund. So you know what? I don't want people to get confused, and thanks for pointing that out. It's assuming that you put money into a short-term investment vehicle. Okay?
So like if it's short term,
Yeah.
you have it under debt service.
Yes, under debt service. You still have it. Yes. Good question.
You don't have it.
You want, yes. Okay. All right, let's go into the it would take us forever to
If it's shorter, you can show it in that service. If it's longer, you can show it in government.
okay. Let's go to the next type of let's look at special assessment. How does special assessment work? Well, the first thing you have to keep in mind with special assessment is what? They benefit what? A specific group of people who then do what? Have to pay for it. And how do they pay for it? By some kind of a levy against them, right? What if they don't pay? Well, there's usually a lien on their property. So the government can actually foreclose on their property. So the important thing here is you have to figure out, before you can record special assessment, what kind of it. If it is one where the government basically, you know, property owners get together, they contract with a contractor, the government is basically a conduit, meaning it's just a clearinghouse. They take the money from the property owners and pay that off to the bondholders. Okay? They have no involvement. If these guys don't pay, then what happens? They, it's too bad. The government doesn't really do anything. The second one is, I hope you're looking at something to do with the text, right? No. You guys are, okay. Just want you to pay attention, okay? The, so special assessments, as I said to you, you have to, first of all, keep in mind how much involvement does the government have. Are they on the hook on the bonds? Okay? If they're on the hook for the bonds, meaning, let's say the property owners put up 80% and these guys put up 20%, the government puts up, that's the special assessment which has to go to the debt service. But if it's basically government as a clearinghouse and they have no involvement, it doesn't belong here at all. It goes to the agency fund. 90% of the special assessments don't go that way. The government in some way, one way or the other, is on the hook. They have guaranteed the debt through, you know the word full faith and credit? Yes. So they've done that, and therefore, and this is where those journal entries would actually be, would come into play. So let's take a look at what happened. So you decided to carry out improvements. You raised $1 million from bondholders. Property owner said, we'll pay you $100,000 each year for the next 10 years with interest. Now remember, you're not using your general taxes to pay for it. So the very first thing you have to do is you have to set up a special assessment, which is assessment receivable current. Okay. You have to debit that account, and that becomes your revenue. Then. This is during the first year. This is the money that's going to be used to pay off the special assessment, right? So let's assume you had $1 million, and I'll use the same example that you have. So you're going to get 100,000 this year, and you're going to get what? 900,000 later. That 900,000 is what? Deferred, right? So everybody see that. So what you'll have is the same thing, except this becomes deferred revenue. And the point is that each year, what do? You take a portion of it and transfer it here. Right? That's what happens. Take what? Each year a portion and make it current. And those are the entries that you see here. Okay? Where they receive it. Okay? And then here it shows the payment of the, but look at how it takes it from deferred and transfers it to the current. And here it shows the payment of interest plus $100,000. So the first year it's 8%. 8% of $1 million is 80,000. What would it be the next year? The interest. 72. And you see the interest what? Declines, right?
Yeah.
Okay. So there's the difference that you need to keep in mind. At the end of the year, as I said, you basically, what do? You reclassify this from deferred revenues to revenues. And that's all there is to it. You just introduced two different accounts. Assessments receivable and deferred revenue. Right? That's all. There is nothing more to it than really that. Now capital lease agreement. What do you remember about capital leases? You know that use requires long-term capital assets. And by the way, what's the journal entry for that? So what do you do in the governmental activities ledger? What do you put in? What's the entry?
Equipment.
You do what? Debit what?
Equipment.
Equipment and credit what?
Long-term capital.
Capital lease payable or whatever, lease obligation. Okay. So those are the entries, right? What happens, by the way, in the general fund, in the governmental fund, when you make the payment?
Expenditure.
That becomes expenditure, right? Each payment that you make towards the capital, remember you had that question from me before?
Yeah.
So each payment that you make becomes what? A expenditure. And this gets what? The capital lease obligation gets amortized, right?
Yeah.
So you reduce that. So really nothing more than that. And what's the amount that's capitalized here? The present value of
minimum lease
the lease. All right, we're moving along. Is everybody still with me? Just stay there. Don't want to lose anybody. I know it's 3 o'clock in the afternoon, but we don't want to lose anybody. Okay. Let's talk about bond refund, debt refunding. Anybody familiar with the term debt refunding? All right, I'll give you a different example. You have a mortgage on your home. When would you want to refinance it? When rates go down. You're refinancing it, right? When else might you want to refinance your mortgage? When you want to get more money. That's what a lot of people did, right? Another reason, why would you want to do it? If the people you borrowed this money from put all these restrictions on your mortgage and made it onerous, right? So you know what? Those are exactly the three reasons for bond refunding. Take advantage of lower rates, extend maturity, or add principal, and three, get rid of restricted bond covenants.
Can you repeat it?
Okay, so the first one, take advantage of the lower rate. And the second is to extend the life of the repayment. Okay. Adding principal, lowering the principal, adding principal or trying to lower the debt service. And third is for technical reasons, which is getting rid of restrictive bond covenants. So with a bond refunding, really sounds complicated. But basically the debt service fund does what? Get the money from the new bond and does what? Pay off the old bond. When refunding bonds are issued, getting money, old bonds are paid off, refunded. Rocket science? No. Let's talk about advanced refunding, and this is not a course in that, and this is a very, very, people get paid really big bucks for doing this type of work. But basically, these are very complex transactions. And what it says is, I'm trying to think of a simple example. Actually, I was involved in a refunding transaction. And I'll tell you the mechanics, and maybe you'll try to understand how it works. So there was a transaction that I was involved in. It was a $96 million transaction. We had to buy an asset. But the asset had some bonds outstanding, and they amounted to $96 million. So the asset could not be sold until the debt was defeased. Word, defeased, not retired, but defeased. Which meant the following. I'll tell you the mechanics. Which meant that what we had to do was go out and buy U.S. Treasury zero coupon bonds, strips. It still had 5 years of maturity left. And zero coupon bonds, for those of you who study finance, what happens? You buy them at a discount and they mature, right?
Yeah.
So we had to buy zero coupon bonds which would mature over the period of time and would add up to $96 million. We took those bonds, and rather we didn't take those bonds, we gave that money to the trustee of the bond who went ahead and bought those bonds. Now, if you were a bondholder, would you be happy at that point? Yeah, money is in the bank, right? Every year, I know that I will get paid. What have I just done? I have done an advanced refunding transaction. Okay, and there are two types of transactions you see in the book. One is called legal defeasance, and the other one is in substance defeasance. And there is a technical difference between the two. But all I want you to do is just think about the concept, which is what the debt has been legally satisfied. Hasn't been paid off, but has been legally satisfied, meaning money's in place and for all purposes has been defeated. And therefore the liability is removed from it. Very little about it. As I said, it's a very complex subject, and really we're not going to go into this, but since it was in the book, I've heard we talk about it.